Interest rates are headed up again. Like, I don't want to sound the alarm and I don't want to be the town crier. I've said rates are volatile and movement will happen. Nothing is in a straight line. Yet, for the past 30 days, I have to admit, I felt a little spoiled. I mean, buyers could get pre-approved, find a home, get under contract, lock in an interest rate, and their rate and payment was the same from beginning to end. We had the luxury of watching interest rates for the national 30-year fixed mortgage rate hover right around 6.6% for the last 30 plus days. But now they've moved up to 6.9%. Now, clearly, it's not the best move, but realistically, it's not the worst. Today, I want to talk a little bit about what's making rates move in this environment in a not-so-favored direction. But before I do, if you enjoy content about the economy, real estate, mortgage rates, do me a favor and hit that thumbs up button and subscribe to my channel so you never miss an update. So the first thing that kicked off this change in direction was Fed Governor Chris Waller on Tuesday came out saying that the Fed is within striking distance of a sustainable 2% core PCE. That's the measure of inflation that the Fed watches, and that should have sent the market to celebrating. But then he said, but. Like, if there's a word I don't like, it's but. But the Fed needs more confirmation before cutting rates. He also went on to say that he thinks the Fed will cut 3 times this year. But, there it is again. But the economy appears to be in good shape and he sees no reason to move quickly or cut as rapidly as in the past. Well, this had an immediate impact on the CME Fed Watch tool that we had been watching that is a measure of investors' idea or their anticipation of where they think the Fed is going to go and how soon they think the Fed is going to start cutting rates. At the beginning of the year, that number was substantially high. It dropped just in a day from where it had come to 68% to 61% just after Waller's comments alone. After Waller's speech, the second market mover was retail sales for December, and it came in especially hot. It was expected to come in at 0.4%, but instead what we got was 0.6% month-over-month growth, and this is up from 0.3% last month. We had seen several month-over-month increases higher than expected, and it's easy to say that it was due to the holidays, that yes, everybody spends more in November and December. We know that. We're all guilty of that. But interesting stat, this is not due to the holidays. This is actually seasonally adjusted. So that's already baked in. It is, however, slightly higher due to higher inflation. I mean, higher costs of everything is going to yield higher sales numbers. But these numbers were their best since September, and they ended 2023 with a record-breaking $5.13 trillion in core retail sales per the National Retail Federation. And as a result, the CME Fed Watch tool for a March rate cut dropped further to a 57% probability rate. The third report that came out cinching our higher rates was the jobless claims, dropping to the lowest we had seen since September. Week over week, 16,000 less people went on unemployment, dropping the total to 187,000. GDP growth for 2023 is looking to be a strong 2.5%. I mean, this is due to a stronger labor growth and stronger productivity growth. And we all know that a strong labor market will also keep inflation from dropping and keep rates higher. On housing news, builder confidence surged 7 points as rates had dropped and mortgage applications increased, with purchase apps up 9% week over week and refinances up 11% week over week. Yes, refinance are up because people are capitalizing on excess equity to consolidate debt, foregoing their low interest rates. If you have a lot of consumer debt, we need to talk. Bottom line, rates will continue to move in a non-linear direction as reports are released and Fed members speak. Ignore the alarms and town criers you hear in the news. For you, the best time to buy or sell is the time that it makes the most financial sense. If you have any questions, drop them in the comments down below and be sure to subscribe if you haven't done so already. Lastly, I would also love to be your mortgage partner. So if you're ready to start your home buying journey today, There's a link down below for our application, and I'll see you next time.